Hello, savvy investors. Welcome back to our channel, where we make the world of finance and investing accessible for everyone. If you're new here, don't forget to hit that subscribe button and the bell icon to stay updated on all our latest content. Today, we're embarking on a particularly exciting journey. We'll explore the roadmap to earning a cool $10,000 from investing in the stock market. Over the next while, we'll delve into 6 key steps that can lead you to this financial milestone. We'll talk about understanding the basics, developing an investment mindset, creating an investment plan, researching stocks, making investments, and finally, monitoring and adjusting your portfolio. So, whether you're a seasoned trader or just starting to dip your toes into the investment pool, this video is designed to give you the knowledge and tools you need to navigate the stock market successfully. Grab your notepads, and let's get started. The vast universe of investing in the stock market can seem bewildering to beginners, but its potential rewards are equally tantalizing, especially when you hear stories of those who have successfully multiplied their wealth. The idea of transforming a moderate investment into a staggering $10,000 might sound like a dream, but with the right knowledge, meticulous planning, and patience, it's an achievable objective. However, it's essential to keep in mind that the world of stocks, like any other investment, carries an element of risk. Investing in stocks refers to buying a fraction of ownership in a company with the expectation that the company's performance will improve, thus increasing the stock's value. The allure of this investment stems from its potential for significant returns, but it's equally important to appreciate that these opportunities come hand in hand with potential losses. So, while the prospect of earning $10,000 from the stock market is certainly enticing, a thoughtful, well-informed approach is crucial to navigating these waters effectively. The journey towards amassing a substantial return from the stock market starts with understanding the fundamentals of investing. The stock market is not a lottery or a quick-get-rich scheme. It's an arena where diligent research, an understanding of market dynamics, and a well-thought-out strategy can lead to meaningful returns. This article aims to guide you through the process, demystifying concepts, and presenting an actionable plan to reach your financial goals. The stock market is driven by the basic economic principles of supply and demand. Companies list their stocks on exchanges, and investors buy these stocks, betting on the company's future performance. When a company performs well, its stocks are in high demand, driving up the price. Conversely, if a company underperforms, the demand for its stocks decreases, causing the stock price to drop. Investing in the stock market requires a balance of knowledge, strategy, and the nerve to stay the course even when the market gets rough. It's about spotting opportunities in companies that are undervalued and buying their stocks, with the expectation that eventually, the market will recognize the company's true value and the stock price will rise. Conversely, it's also about recognizing when a company is overvalued and knowing when to sell. One of the key takeaways should be that investing in the stock market isn't about making quick money. It's a long-term commitment. While some people might get lucky and make a large sum of money quickly, more often, significant returns are the result of careful planning and long-term investing. You are more likely to reach your goal of $10,000 by staying in the market and weathering its ups and downs, rather than attempting to time the market for quick gains. As you embark on this journey towards earning $10,000 from investing in stocks, it's crucial to arm yourself with knowledge, develop a robust investment plan, and manage your expectations. This is the surest path towards achieving your financial goals and avoiding the pitfalls that can trip up less prepared investors. In the following sections, we will delve into the nuts and bolts of how to create your investment plan, conduct research, make investments, and monitor and adjust your portfolio. The road may not always be smooth, but with a well-prepared strategy and patience, your chances of reaching that $10,000 milestone are markedly improved. In the realm of investing, knowledge is power. By understanding the stock market's foundational concepts and mechanisms, you can position yourself for a more informed and strategic approach to your investments. This section will help you comprehend the essence of stocks, how they work, the factors that affect their prices, and how to transact in them. A stock represents ownership in a company, making the stockholder a partial owner of that firm. Each unit of stock, known as a share, denotes a piece of the company's assets and earnings. When you buy a company's stock, you're purchasing a piece of that company, including its potential future earnings and any dividends it might distribute to its shareholders. Stocks are mainly traded on exchanges, such as the New York Stock Exchange, NYSE, or the Nasdaq, among others worldwide. These exchanges serve as marketplaces for buyers and sellers to trade stocks. To buy or sell stocks, investors generally need to open a brokerage account, which acts as an intermediary between them and the exchanges. There are several types of stocks you should be aware of. Blue-chip stocks belong to well-established, financially stable companies with a history of reliability. They are less risky and often pay regular dividends, making them a staple in many portfolios. Growth stocks belong to companies expected to grow at an above-average rate compared to other firms in the market. They are potentially profitable but also riskier. Dividend stocks belong to companies that regularly distribute a portion of their earnings to shareholders. They provide a steady income and are often favored by income and long-term investors. The price of a stock is influenced by a multitude of factors, with the company's financial health being one of the most critical. This includes its earnings, assets, liabilities, and more. However, broader economic conditions, political stability, industry trends, and market sentiment also play a significant role. A positive earnings report can drive a stock's price up, while economic instability can cause a general market downturn. Stocks are bought and sold through a process of bidding. Buyers propose a bid, which is the maximum amount they're willing to pay for a stock, and sellers offer an ask, the minimum amount they're willing to accept. When these match, a trade is made. Understanding these basic concepts is vital for any potential investor. However, diving into the stock market is not a decision to be made lightly or without thorough due diligence. It's a complex, constantly shifting landscape that requires keen attention and an analytical mind. In the following sections, we will discuss creating an investment plan, researching stocks, making investments, and managing your portfolio, all vital steps in your journey towards earning $10,000 from stock investments. Remember, knowledge is your first investment, and potentially your most profitable one. Embarking on your investment journey without a solid plan is akin to setting sail in uncharted waters without a compass. An investment plan is a strategic roadmap that outlines your financial goals, risk tolerance, investment timeframe, and preferred investment vehicles. It serves as a guide, helping you make consistent decisions aligned with your financial objectives, which, in this case, is earning $10,000 from the stock market. The first step in crafting an investment plan is defining your financial goal. Having a specific objective focuses your plan and helps determine your strategy's timeline and risk tolerance. In this scenario, the goal is clear: earn $10,000 from stock investments. However, the time frame for achieving this goal can vary based on the initial investment and expected annual returns, which will help determine the degree of risk you can afford to take. Risk tolerance is a fundamental component of your investment plan. It refers to the degree of uncertainty in investment returns that an investor is willing to withstand. Determining your risk tolerance involves a careful examination of your financial situation and your emotional ability to withstand potential losses. Younger investors or those with stable income streams may have a higher risk tolerance, while older investors nearing retirement or with uncertain income may be more risk-averse. Understanding your risk tolerance will help guide your investment decisions, especially when choosing which stocks to invest in. The principle of diversification is another critical element in your investment plan. Diversification means spreading your investments across different assets, stocks, bonds, etc., or different sectors, technology, healthcare, etc. This strategy can help mitigate risk because the poor performance of one investment can potentially be offset by the strong performance of another. When it comes to stock investing, consider diversifying across different sectors and company sizes. Asset allocation goes hand in hand with diversification. It involves dividing an investment portfolio among different asset categories, such as stocks, bonds, and cash. The process of determining which mix of assets to hold in your portfolio is a very personal one. The asset allocation that works best for you at any given point in your life will depend largely on your time horizon and your ability to tolerate risk. Finally, it's important to regularly review and adjust your investment plan as necessary. Life's unpredictability necessitates flexibility in your plan. Whether it's a shift in personal financial circumstances, changes in the broader economic landscape, or moving closer to your financial goal, adjustments are part of the journey. In the following sections, we'll explore how to research stocks effectively, how to go about making investments, and the importance of actively monitoring and adjusting your portfolio. Remember, an investment plan isn't a set-it-and-forget-it proposition. It's a living document that can evolve as you move closer to your financial goal of earning $10,000 from stock investments. In the stock market, doing your homework pays off, literally. Thorough and accurate stock research is the cornerstone of successful investing. It gives you a clear understanding of the companies you're considering, their prospects, and how they fit into your overall investment plan. This section will guide you through the process of researching potential stock investments, which includes fundamental analysis and technical analysis. Fundamental analysis involves studying a company's financials to determine its value and potential for future growth. It's like peering under the hood of a car before buying it. Do you want to know that the engine is sound? Key financial metrics such as revenue, earnings per share, EPS, price to earnings, P/E ratio, and debt to equity ratio, among others, can provide insight into the company's financial health and stability. Revenue and EPS are straightforward. Do you want to see them growing over time? The P/E ratio compares a company's current share price to its earnings per share. A high P/E ratio could suggest that a company's stock is overvalued, or it could signal that investors are expecting high growth rates in the future. The debt-to-equity ratio compares a company's total liabilities to its shareholders' equity. A high ratio might indicate that a company has financed a large part of its growth by debt, which could be risky if it's not able to meet its debt obligations. In addition to these financial metrics, you should also consider the company's competitive position within its industry, its management team, and the potential growth of its market sector. All these factors can significantly impact a company's performance and, consequently, its stock price. While fundamental analysis examines a company's intrinsic value, technical analysis focuses on statistical trends based on market activity, such as past prices and volume. Traders use chart patterns and indicators to predict future price movements. They believe that historical performance is a good indicator of future performance. While this approach can be useful, especially for short-term trading strategies, it should be used in conjunction with fundamental analysis for long-term investing. Reviewing analyst reports can also be helpful. Many financial institutions and independent research firms publish their analyses of different stocks, which can provide valuable insights. However, these should not be your only source of information. Differing methodologies can lead to varying conclusions, so it's essential to understand the assumptions and perspectives that underpin these analyses. In conclusion, researching stocks is a vital step in your investment journey. It provides you with the necessary knowledge to make informed decisions about which stocks to include in your portfolio. In the upcoming sections, we'll discuss how to make investments and the importance of regularly monitoring and adjusting your portfolio. Remember, the goal is to earn $10,000 from stock investing, and effective research is an indispensable tool in achieving this goal. With a well-crafted investment plan and thorough research in your arsenal, you're now ready for the next significant step in your journey, making investments. This section will guide you through the process of buying stocks, including choosing a brokerage, understanding order types, and timing your purchases effectively. Firstly, you'll need to choose a brokerage. A brokerage is a firm that acts as an intermediary between you and the stock exchanges. They execute your trades and hold your investments in an account. When choosing a brokerage, consider factors like transaction fees, ease of use, customer service, research tools provided, and whether it's insured by the Securities Investor Protection Corporation, SIPC. Some brokerages also offer robo-advisors, automated investing platforms that can help manage your portfolio. After setting up your brokerage account, it's time to buy stocks. However, it's not as simple as clicking a buy button. You need to understand different order types. A market order is an order to buy or sell a stock at the current market price. It's executed quickly, but the final price may vary if the market is volatile. A limit order is an order to buy or sell a stock at a specific price or better. It offers price control, but there's a risk the order may not be executed if the stock doesn't reach your specified price. In addition to deciding the order type, you must also decide the number of shares you want to buy. This decision should be based on your investment plan and the diversification strategy you've set for your portfolio. Make sure you're not overexposing yourself to a single stock, no matter how confident you are about its prospects. Timing your purchases can be tricky. The common saying in the stock market is, time in the market is better than timing the market. It's often impossible to accurately predict short-term market movements consistently. Therefore, a long-term investment strategy often proves more effective. Buying stocks at regular intervals, a strategy known as dollar cost averaging, can also help spread risk. Be aware that investing in stocks also involves costs such as brokerage fees and potential taxes on capital gains and dividends. Make sure to account for these when calculating your returns. Also, remember to keep some cash reserves for unexpected needs or investment opportunities. As a concluding note on this step, investing in stocks should never be done impulsively. It requires thoughtful consideration based on diligent research and adherence to your investment plan. In the following and final section, we will explore the importance of regularly monitoring and adjusting your portfolio, another crucial step towards your goal of earning $10,000 from stock investing. Remember, every investment decision you make brings you one step closer to your financial target. The final but equally crucial step in your journey to earning $10,000 from the stock market is consistent monitoring and timely adjustment of your portfolio. This phase ensures that you remain aligned with your investment plan, adapt to market changes, and optimize your returns. Monitoring your portfolio involves keeping a close eye on your investments and the overall market conditions. Regularly review the performance of individual stocks in your portfolio. Look at their earnings reports, news updates, and any other relevant information that could impact their value. Keep track of trends in the broader market and the specific sectors in which you've invested. Major economic events, changes in government policy, or shifts in consumer behavior can significantly influence the stock market. The objective of monitoring isn't to react to every market fluctuation, but rather to ensure your investments continue to align with your investment plan and goals. Frequent buying and selling, often driven by short-term market volatility, can lead to higher transaction costs and potential investment mistakes. Remember, a successful investment strategy is often a long-term game. Rebalancing your portfolio is an integral part of its management. This process involves realigning the proportions of your assets to maintain your desired level of risk and return. For instance, if one of your stocks has performed exceptionally well, it may now make up a larger percentage of your portfolio, thereby increasing your exposure to risk from that particular stock. In such cases, you might consider selling some shares of that stock to rebalance your portfolio. Moreover, as you move closer to your goal of earning $10,000, you may want to gradually reduce your risk level to safeguard your gains. This could involve shifting some of your investments from higher risk stocks to lower risk assets. It's important to note that rebalancing can have tax implications due to the capital gains realized from selling investments. Therefore, it's wise to consult with a financial advisor or tax professional when making significant adjustments. Lastly, always keep an emergency fund separate from your investment portfolio. This fund acts as a financial safety net and should cover several months of living expenses. It's meant to help you navigate unforeseen expenses or financial crises without the need to sell your investments at a possibly unfavorable time. In conclusion, the journey to earning $10,000 from investing in the stock market isn't necessarily a straight path. It requires planning, knowledge, careful investment decisions, and consistent portfolio management. However, with patience, diligence, and a keen eye on your goals, you can navigate the financial markets successfully. Remember, the journey of investing is as much about learning and growing financially as it is about reaching your financial target. Happy investing. And that, folks, concludes our comprehensive guide on how to earn $10,000 from investing in the stock market. We've traversed through understanding the basics, developing an investment mindset, crafting an investment plan, researching stocks, making investments, and the crucial process of monitoring and adjusting your portfolio. Remember, investing is as much about patience and continuous learning as it is about making sound financial decisions. Stick to your plan, keep learning, stay patient, and you'll be well on your way to that $10,000 mark and beyond. If you found this video helpful, please give it a thumbs up and share it with your friends and family. We'd love to hear about your investing journey, so don't forget to drop a comment below. And if you haven't already, subscribe to our channel and hit the bell icon for more financial insights and tips. Remember, the journey of 1,000 miles begins with a single step, or in this case, the journey to $10,000 starts with understanding the basics. Until next time, stay smart, stay savvy, and happy investing.